If you woke up today and saw silver gap up $3 overnight, right after it got smashed down into the $75 zone, and your first thought was, oh, it's just bouncing, you're about to get played. This is not one of those cute little green candle hope is back mornings. This is the kind of open that tells you something mechanical just happened behind the curtain. Because gaps don't happen when everyone is calmly agreeing on value. Gaps happen when the market can't find sellers at the old price. A gap is not a mood. A gap is a shortage of liquidity at a specific level. And after a violent crash, a gap up is either a dead cat bounce, the market giving you hope so it can sell into you, or a short trap, the market forcing people to buy back risk at any price, fast. So today we're going to answer one question like adults. Is this a dead cat bounce? Or did the shorts just get margin called into a squeeze? And I'm going to give you a framework to tell the difference in real time. Not vibes, not Twitter, not I feel bullish, signals, mechanics, behavior, because in markets like this, your feelings are expensive. Last night wasn't a dip, it was a public execution. Silver crashes down into $75. Not slowly, not politely, it drops like the floor fell out. That kind of move does two things at the same time. It punishes late longs who chase the top. It rewards shorts who feel like geniuses for about 5 minutes. And right there, right in that emotional wreckage, shorts get cocky. Because shorts love one thing more than being right. They love believing the panic will last. They love believing they're about to ride it down while everyone else cries. And that's exactly when the market sets the hook, because the best short squeeze setups don't start with strength. They start with weakness that creates confidence. A squeeze needs shorts to pile in. A squeeze needs them to feel safe. A squeeze needs them to add leverage at the worst time. So if you want to understand this gap up, you have to understand what the crash did. It wasn't just price moving. It was the market rearranging who is holding risk. It moved risk from strong hands to weak hands, then it waited, and then it ripped it back. What a 3 overnight gap really means. Let me translate gap up 3 overnight into plain English. It means there was a price where shorts expected to cover, and that price didn't exist anymore. That's it. That's the whole story. A gap up isn't a polite invitation. It's the market saying, sorry, no liquidity at your level. You want out? Pay up. And when silver gaps after a crash, it's usually one of 3 things. Possibility A, a normal bounce, dead cat bounce. Short-term traders buy because it's oversold. Price pops, then rolls over, then fills the gap. Possibility B, a positioning snap, short squeeze begins. Shorts are forced to cover because their risk model breaks. Stops trigger, margin calls hit. They buy back contracts into thin liquidity. Price jumps again. Possibility C, a funding, options mechanic, the hidden engine. Dealers hedge, volatility shifts, gamma flips. The hedging flow creates forced buying even without news. Most people only see candles. Professionals see who is forced, because forced buyers don't negotiate. They pay. Why shorts get trapped after a crash? This is the part that matters. Everyone understands long liquidation. People talk about it all day. But short liquidation is the one that melts faces. Here's how the trap forms. Step 1. Crash creates proof. The market drops hard. Shorts say, see, I told you weakness, top is in. Step 2. Shorts add at the bottom. They short the breakdown. They short the retest. They short because it feels safe, and they use leverage because they feel smart. Step 3, the market opens higher. Not a little higher. Higher enough to hurt, higher enough to invalidate the story. Step 4, stops start firing. Short stops are buy orders. When price gaps up, those buy orders hit thin liquidity. Step 5, margin calls begin. This is where it gets ugly, because shorts don't lose gradually. They lose suddenly. They wake up already in pain, and if their position is leveraged, they don't get to wait it out. They get a call. Add cash, reduce risk, close now. Step 6. Forced covering creates the next leg, and that's when the squeeze becomes self-feeding. Shorts buy to cover, price rises, more shorts hit stops, price rises, more margin calls, price rises. That loop is what a squeeze is. It's not hype. It's math and risk control. The most important thing to understand today. Let me say the most important line in this whole video. A short squeeze is not a price prediction. It's a forced behavior prediction. If you can identify forced behavior, you can survive the chaos. If you can't, you'll get emotionally farmed. So today, the job is not bullish or bearish. The job is the market forcing shorts to buy back risk? And the answer shows up in behavior, not in your opinion. Dead cat bounce versus short squeeze, the real-time checklist. Let's settle this like professionals. Here's how you tell the difference between nice bounce and short trap starting. 1. Does the gap hold or does it fill fast? A dead cat bounce often fills the gap quickly. A squeeze often does the opposite. It holds the gap like a scar. If price tries to dip into the gap and instantly gets bought, that's not retail hope. That's real demand or forced covering. 2. Do we see ugly candles upward? Squeeze candles often look violent and irrational. They don't look like clean stair steps. They look like sudden spikes, shallow pullbacks, relentless reclaiming of levels. Because forced buyers don't wait for a better entry. They buy now. 3. Does the market refuse to give you a perfect entry? Dead cat bounces feel tradable. They give you time. They give you retests. They give you that "I'll just wait for confirmation" comfort. Squeezes don't do that. Squeezes feel rude. They move before you're ready. 4. Does volatility stay elevated while price rises? In a healthy rally, volatility calms down. In a squeeze, volatility stays hot because the market is still unstable. Hot vol plus rising price often means someone is being forced. 5. Do key pain levels get reclaimed quickly? After a crash, there are levels that matter psychologically. If silver reclaims them quickly, especially overnight, something changed. Not sentiment, positioning, risk. Why the gap up happened. Now you might be thinking, why would the squeeze begin right after a crash? Because the crash is what sets the trap. The crash does two important things. It resets positioning. Weak hands are flushed out of longs, new shorts pile in confident. That creates a fat pool of short risk. It creates the perfect cover story. When price gaps up, it doesn't look like manipulation. It looks like a normal bounce. And that's important, because the market loves to do violent things under boring explanations. Profit taking, buy the dip, short covering. Simple words, huge consequences. The two worlds, screen world versus margin world. Now we go deeper, because a gap up after a crash is usually not about belief. It's about margin. There are two worlds. World A, screen world. People argue candles. They screenshot charts. They chant numbers. World B, margin world. People get emails. People get calls. People get forced. Margin world is where this starts, because when silver whips like this, the rules change. Risk desks tighten limits. Brokers raise requirements. Volatility increases margin. And suddenly the same position size becomes impossible to carry. That is when trades get closed against people's will, and that is how squeezes are born, not from passion, from constraints. Why this could be the start of a real squeeze. Let's talk about what makes this moment dangerous. Silver is not just a metal. Silver is a thin market with leverage attached, meaning it doesn't take a huge amount of money to create a huge move. That's why silver can rip your face off in both directions. Now add this. After a crash, liquidity thins out shorts, think they're safe. Longs get cautious market makers widen spreads, and suddenly, a moderate burst of buying causes a large gap. That's when squeezes begin. When price moves faster than positioning can adjust. So the question isn't, is silver strong? The question is silver moving faster than shorts can survive? That's the squeeze question. The China layer, why it matters even if you trade paper. Now let's address the part most people ignore. China. Here's the mistake Western traders make. They assume everyone trades like Wall Street. Fast profit, quarterly results, flip inventory. China often plays a different game. They care about industrial continuity, supply chain advantage, stockpiling, strategic access. So even if you are trading paper silver, China matters because it affects one big thing: the market's belief that supply will show up when price is high enough. In a normal market, higher prices bring sellers. In a tight market, higher prices bring hoarders. And hoarders do not sell just because price moved up. They sell when it serves strategy. So if physical tightness persists, paper drops become less trustworthy because paper can get flushed while physical remains tight. That's how dislocations are born. That's how dead cat bounces turn into why is it still bid? What a real short squeeze would look like from here if this is real. If the squeeze is actually beginning, here's the sequence you usually see next. Phase 1, gap up, shock. Shorts feel discomfort. Some cover. Price holds higher than expected. Phase 2, dip that won't dip. Market tries to fill the gap. Buyers show up earlier than expected. That's the first clue. Phase 3, a second push. The second push is important because it confirms the first move wasn't just a bounce. It means demand covering is still there. Phase 4, panic cover through key levels. Shorts begin to hit hard stops. That's when you get vertical candles. Phase 5, it doesn't make sense day. That's the squeeze day. The day when bears say, this is irrational. Yes, squeezes are irrational by design. They are not price discovery. They are risk removal. What a dead cat bounce would look like from here now. To be fair, it could be a dead cat bounce. So what would that look like? 1. Gap fills easily. Price drifts down, fills the gap, and doesn't fight for it. 2. Reclaim fails. When price tries to bounce again, it can't. It gets sold quickly. 3. The market returns to the crash narrative. People start saying, "See, it was just a bounce." A dead cat bounce restores the old story. A squeeze kills the old story. That's the simplest way to think about it. The real signal. Who looks uncomfortable? Here's a trick. In these moments, watch which side looks uncomfortable. If bulls look uncomfortable, they chase, they hesitate, they take profits fast. They don't trust the move. That often means bounce. If bears look uncomfortable, they stop posting, they start rationalizing, they start saying it's manipulated, they start praying for a pullback. That often means squeeze. Because discomfort is information. This is not financial advice. This is how not to get emotionally farmed advice. If you are trading paper silver, don't worship gaps. Don't short strength just because you think it's overbought. And don't go maximum size in a market that just moved 8% in hours. Markets like this punish arrogance. If you are holding physical, your world is different. Your world is availability premiums, delivery time trust. A screen dip does not change the metal in your hand, but it can change the behavior of people who need metal, and behavior is what moves regimes. Let me give you the clean takeaway in one sentence. This $3 overnight gap is the market asking, are shorts still in control, or are they now the fuel? If the gap holds and we see shallow dips getting bought, the squeeze is not a theory, it's a process. If the gap fills and price collapses back into the crash zone, then yes, dead cat bounce. Either way, you do not handle this market with ego. You handle it with signals. So here's what I want you to do. In the comments, tell me what you saw on your screen. Did it gap up and hold, or did it gap up and bleed? And if you want part 2, where I map the next pressure shelves and explain what margin call behavior looks like before it shows up on your chart, comment one word: revenge. Because if the shorts are trapped, the next move won't be polite. It will be fast. And in silver, fast moves don't ask permission. They take it. I'll see you in the next one.